Raising your first round and confused about safes versus equity? This decision will impact your ownership, valuation, and future fundraising for years to come. Today, we're breaking down everything founders need to know about safes and equity, the pros, the cons, and the hidden traps that catch first-time founders off guard. This could save you millions in dilution. Hit subscribe and let's dive in. Understanding what a safe really is. A safe, simple agreement for future equity, was created by Y Combinator to simplify early-stage fundraising. Unlike traditional equity, a safe is not stock. It's a contractual promise that converts into equity later, typically during a future-priced round. Safes allow founders to raise capital quickly without determining a company valuation immediately. This sounds attractive, but it creates complexity down the line. The safe sits on your cap table as a liability until conversion, and founders often underestimate how much dilution they're actually agreeing to. Understanding that a safe is deferred equity, not free money and not a loan, is the first critical step. It's a placeholder that will eventually claim a piece of your company, often more than founders initially realize. How safes convert into equity. The conversion mechanism is where safes become complicated. Most safes convert during a qualified financing round when the company raises a specific amount at a set price per share. When conversion happens, safe investors receive shares as if they paid less than the new round price, or as if the company was worth less than the current valuation, whichever is more favorable to them. This means early safe investors get better terms than later investors, which sounds fair, but can create significant founder dilution that wasn't obvious at signing. Traditional equity. Explain. Traditional equity means selling actual shares of your company at an agreed-upon valuation. Investors receive stock immediately with defined ownership percentages, voting rights, and liquidation preferences. Priced equity rounds require negotiating a company valuation, which can be time-consuming and contentious for early-stage companies with limited traction. Equity rounds typically involve more extensive legal documentation, term sheets, and due diligence, but they create a clean cap table with transparent ownership stakes. For founders who want certainty and clear communication with investors, traditional equity offers advantages despite requiring more upfront work. The appeal of safes for founders. Safes became popular because they solve real problems for early-stage founders. They're faster and cheaper to execute than priced equity rounds, often requiring just a few pages of documentation instead of extensive legal agreements. Safes eliminate the need to negotiate company valuation when you have minimal traction, which can be uncomfortable and difficult. They allow founders to raise capital and keep building without getting stuck in lengthy fundraising processes. These benefits make safes attractive for friends and family rounds, angel investments, and accelerator programs where everyone wants to move quickly. The hidden risks of safes. Despite their simplicity, safes carry significant risks that founders often discover too late. The biggest risk is dilution uncertainty. Since safes convert later, founders don't know their actual ownership percentage until conversion happens. If you raise multiple safe rounds with different caps and discounts, the math becomes extremely complex. Many founders are shocked when safes convert, and they own far less than expected. Finally, some sophisticated investors view excessive safe usage negatively, seeing it as founders avoiding difficult valuation conversations or lacking financial sophistication. Valuation caps and discount rates. Explained. Understanding safe terms is essential. The valuation cap protects investors by setting a maximum company value for their investment conversion. If you raise a safe with a $5 million cap and later raise a Series A at a $20 million valuation, safe investors convert as if your company was worth only $5 million, giving them 4 times more shares per dollar invested than Series A investors. These terms are investor-friendly by design, rewarding early risk. Founders must model different scenarios to understand potential dilution. A generous cap might feel good when raising, but becomes painful when converting at a much higher valuation. When to choose safes over equity. Safes make sense in specific situations. They're ideal for small friends and family rounds where speed matters and investors trust you without demanding complex terms. If you're raising significant capital, have meaningful traction, or attracting institutional investors, a priced round often makes more sense despite added complexity. The key is matching the instrument to your stage. investor type, and strategic goals. When equity makes more sense, traditional equity is preferable when you have sufficient traction to justify a meaningful valuation. If you're generating revenue, have strong user growth, or possess valuable intellectual property, you can defend a valuation and should consider a priced round. Equity makes sense when raising from institutional investors like venture capital firms who expect standard equity terms, board seats, and governance rights. Founders who want to professionalize their cap table and establish clear governance should prioritize equity over continuing to stack safes. Managing cap table complexity. Your cap table is a living document that shows who owns what percentage of your company. Safes complicate cap tables because they represent future equity, not current ownership. Managing multiple safes with different terms creates scenarios where you can't precisely calculate ownership until conversion. This uncertainty makes it difficult to plan future raises, grant employee equity, or communicate ownership clearly. A messy cap table with excessive safes can scare away sophisticated Series A investors who see complexity and potential conflicts. Keeping your cap table clean and understandable is a competitive advantage when raising future rounds. Converting safes and avoiding disasters. When your priced round finally happens, all outstanding safes convert. This is when founders face reality. If you raised aggressively on safes without tracking dilution, conversion can be devastating. Founders have lost majority control before raising a Series A because they didn't model safe dilution properly. To avoid disasters, limit total safe fundraising to reasonable amounts relative to your future valuation expectations. Communicate transparently with safe holders about conversion timing and terms. Most importantly, get legal and financial advice before raising significant amounts on safes. A small investment in professional guidance prevents expensive mistakes. What founders must understand before raising choosing between safes and equity isn't about which is better. It's about which fits your situation. Safes offer speed and simplicity but create deferred dilution and cap table complexity. Manage your cap table carefully and seek professional advice. The decisions you make in early fundraising will impact your ownership and control for the life of your company. Understanding safes versus equity isn't optional. It's essential knowledge that separates successful founders from those who lose their companies to preventable dilution. That's what every founder needs to know about safes versus equity before raising capital. If this saved you from a costly mistake, smash that like button, comment with your questions, and subscribe for more fundraising strategies that protect founder equity. Remember, speed is good, but understanding the terms is better. Now go raise smart capital.